You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
It's good to be back, Jim. You know, the market may be kind of in the doldrums right now, in the summer doldrums, but the weather is beautiful, and I'm expressing gratitude for that.
Yep, 95 today, the high in Vancouver in the Valley. So, yeah, summer's here. And I know a lot of people don't pay attention. It seems they think financial stop or something if you're on holiday, and we know they don't. And so today we're going to talk about streamers and royalties. I think we understand what royalties are, but maybe people aren't aware what the term streamer means.
Well, streamers and royalty companies' business model have certain similarities, and what I'd like to do is just give a very brief definition of how a streamer works, and then I'd suggest that people go and Google the royalty companies terms and streaming companies, those two terms, and they'll find out all that they want to know about that, because the agreements themselves can take a variety of permutations. Essentially what a streamer business model does is that it offers an upfront payment to help a miner go into or expand operations in exchange for a portion of its future production or stream. And this can be from precious metals or base metals, or even something as varied as natural gas, coal, uranium, or even residential houses. So the term of such a streaming agreement takes a variety of forms, and by people doing the research, as Pat Gorman says, education before acquisition, they can see if this concept appeals to them.
Right, and of course royalties, anybody knows, that's the sweet part of any deal.
It really is, and of course the thing to remember too is that any resource sector company purchase, even a streaming company, you always have risk. There's no way to say that there is no risk. It has to do with the concept of threat management or risk management. So you try to choose companies and management teams and projects and locations in ways that minimize your risk or keep it under some type of control. And that's how you manage it. But don't ever feel that, oh, I have this company and there's no risk. Because then when something comes up unexpectedly, you will, instead of being alert and making rational, intelligent decisions about whether you should buy or sell or add more, you're going to react fearfully, and you'll be making emotion-driven ones, and that's what you want to try to avoid.
We know emotions always seem to mess up everything.
They really do. You need to realize that in any resource sector company that you hold, stuff happens. And to me, it's not so much about what happens, although that can be pretty important, but it's how management deals with the problem. It's always what you want to look at. How does management handle this problem? And so you base your buy or hold or fold decisions on how management responds to the issue at hand. And over time, when you see a history of how they've done it, you can either have more or less confidence that they'll be able to do the right thing whenever something comes up to you at the position that you hold.
You pointed out, too, how important is management? Well, nothing that you write down on paper and here's the plan. When you're dealing with a physical product like a mine, how do you know that you're going to hit a great big underground lake of salt water or something like that? So you have to be prepared for things to change.
Yes, mining is inherently risky. It has complexities to it. And, if you look at what's all that's going on in different projects today, not just to mention the actual digging into the ground and getting the mine into production and getting the mill going and making it work and all of this kind of stuff, and separating the mineralization. I mean, these are all technical things that have to do with the mining process itself. But when you add in the social issues, the political ramifications, the financial situation of the world, you can really see that a mining operation is a fish swimming in the water of all the social things that are going on and political things, and you can't separate the fish from the water.
I guess the best example of that is Barrick Gold and its Pascua Lama mine on the Argentinian-Chilean border. Court has again frozen any work there until they meet certain environmental standards.
This continues to be a fascinating subject, and frankly, I just enjoy reading about it, not because of the trouble that Barrick is going through, but because it points out all the different things involved in the complexity and perils of mining. And it also points out something very directly to what we're talking about here today in regards to the fact that a streaming company can lessen an investor's risk rather than holding an outright project. In the case of Barrick, of course, that's the project itself and the company, and its stock is suffering in no small part due to this controversy over Pascua-Lama, and is no doubt will be affected for quite some time, in addition to the fact of gold being and silver being languishing currently. But if you look at the streaming company, which has a project stream with Barrick, that company is being affected too, but much less on a percentage basis. Number one, because this project is one that they have. It's a big one, but it's not the only thing they have. They have a number of other projects. And so the streamer will tend to be affected in a smaller way than if you have the outright project. And you know, Jim, I can give you a recent example from personal experience that I think bears this out. I hold a particular company that very recently announced a production delay because of a situation in their underground mining setup, and that company lost 50% of its already depressed stock share value in one day as a result of that announcement. Now, my perspective is that the company is still a viable project, and it'll be coming on stream a little later, but it has very high grades, and I want to continue holding it. So here in my portfolio, that particular position I have is down 50% over one day. However, I also hold the company that has a streaming agreement with that project, and that company stock dropped a little bit because of that, but it was a matter of just a few percentage points because this is one of a number of projects that they hold. So I can tell you from personal experience that holding a streaming company in a general sense is very likely to lessen your risk to these surprises that inevitably come up in the mining sector than if you only held projects from specific companies alone themselves.
Yeah, and talking about Barrick Gold, late last week, we were talking early last week about perhaps a write-down of $5.5 billion for Barrick, and then TD said that, gee, it could be up to $10 billion. Now, that's what they were hoping to get out of this mine, wasn't it? About $11 billion worth of gold?
Something like that, and we don't know what the final figure is going to be, but it's going to be a large figure, it appears, unless they really pull a rabbit out of a hat. And this brings us to another point that I think is important when anytime we talk about aspects of a portfolio, no matter how good the story of the streaming concept or the royalty concept seems to be, it's important, I think, that people not go whole hog and say, oh, my whole portfolio will become streamers because I can limit risk. It's a specific tool. It provides variety, and there are compelling reasons to consider them. But you know, you want to consider other things as well too, and not just the streamers. Even though I think that they're a very important thing to consider. And what I'd like to do today, Jim, in closing, is to share a quote with our listeners that Louis James said recently about trying to buy the bottom. You know, we're looking at prices in here, and there's all sorts of articles and reports coming out lately about whether this is the bottom for gold and silver and the mining shares. And there's some interesting considerations that it may be the case, but it may not be too. So here's what Louis James says, quote, "Not only can nobody time the market, those who have made fantastic amounts of money speculating in this sector didn't even try. They made money buying when valuations were ridiculously low and simply waiting to be right," end quote. So if you think that owning a streamer in today's beaten down markets makes good sense, and I do, I think it makes sense to certainly look into, then my suggestion is do the research, do the math, and perhaps take a position. And then after that, if you've done these things, as Louis James would say, simply wait to be right.
And it's always hopeful that way. Now, really, realistically, we know that the price of gold and silver is pretty well at the cost of production. A company, if the price is going any lower, it's just not worth their time and effort to take money out or to take the gold out of the ground if you're not going to get much for it. And even El Dorado, another major company, says it's cutting its capital spending. That's new plans to build stuff and expand because of the low price of gold. Could companies be choked out right now?
That is true, Jim, and I think it's an important consideration, but I also think that investors too often make decisions based upon what you were just commenting on. Just because the metal is below the cost of production doesn't mean now is the time to jump in with both feet because it's going to bounce up. Because there are so many cost attendance going along to a mining project that many times the company will have to keep operation just in order to pay the rent and to keep their leases on their land from expiring in their holdings. And the cost of starting up a mine again after they closed it and getting the permits and getting the approval again, it can be prohibitive, such to the point that in many cases a mine will keep going simply to keep the lights on because they can't afford to close even though they're losing money by staying open. So it's a matter of losing less money by staying open and hoping for higher prices than closing and waiting for higher prices. So this is a consideration when people make their investment decisions, but I really think that people should consider the fact that many of these mines will stay open regardless, even producing at a loss. That's what you see in South Africa today, and that's what you're going to see in many other cases. So use that as a consideration, but don't make it necessarily a buy-sell decision simply because the metals are trading at below the cost of production.
David, always a pleasure talking to you. Enjoy the warm weather, and we'll talk to you next week.
It's great. I will, Jim. Thanks for speaking with me.
My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can contact us with any questions or comments at info@HowStreet.com. I'm Jim Goddard.